Second quarter growth cooling to 4.3% in China, falling short of its full-year target and the slowest expansion since 2022. Deborah Wong with this report.
5 months into the Iran conflict, China is feeling the squeeze of a global economic slowdown and a persistent property slump. While quarterly growth has hit a 3.5-year low, first-half GDP figures still scraped by at 4.7%, keeping Beijing's 2026 growth targets within reach.
上半年经济顶住压力，运行在合理区间，生产供给较快增长，就业形势总体稳定，物价温和上涨。 对外贸易真是良好。
China's exports once again did the heavy lifting, with global AI spending and shifts to clean energy fueling demand for Chinese chips and electric vehicles. But analysts warn this cannot carry the entire economy.
When we look at the June data, China's export was 20-something up compared with last year, but China's import was 30-something up compared with last year. It's actually telling us that China's net export could be smaller than the first quarter. So what China needs to do in the second half of the year is to boost both consumption and investment to mitigate any downside impact of net export, not just the export.
Yet domestic consumption remains weak. June retail sales inched up 1%, following declines in the previous month. Experts point to the need for structural reform.
The more sustainable way to support China's consumption is to create more jobs in the service sector, and that will take quite a long time to adjust. For China to deliver its consumption in a more sustainable way, it has to be broader based and reform instead of any short-term coupons.
Fixed asset investment, which typically includes infrastructure and manufacturing spending, plunged 5.7% in the first half of the year. Government crackdowns on price wars could weigh on investment growth in the near term, but economists believe it will restore long-term profits. They expect the outlook to remain negative for the rest of 2026 as local governments prioritize debt management. However, it could offer a window for reform.
This year is actually a gap for policy to actually deliver strong investment. We're talking about the U.S.-China stabilization. After May, there was a term called strategic stability, that the two sides are not adding tariff to each other. And there are 3 more meetings coming between the two leaders in the second half of the year. However, who knows what's the next year, and especially in 2028, that's when the U.S. transition is going to happen. So this is actually a rare window for China to deliver reform. So any reallocation of the money is likely to be more missed.
Premier Li Qiang hinted at expansionary policies earlier this week, but the real test comes at the end of the month. Now that's when China's Politburo, the country's top decision-making body, will reveal first-half data and plot next steps. Until then, the markets are left waiting. Deborah Wong, CNA, Shenzhen.
Dr. Zoe Liu Zongyuan joins us now. She's Maurice R. Greenberg Senior Fellow for China Studies at the Council on Foreign Relations, speaking from New York. Dr. Liu, this rare window for reform, given these figures, whether growth or investment in fixed assets or retail sales, do you see China having the space right now to deliver on those rare reforms?
Sue, thank you very much for having me. I'd say yes, the economic numbers are weak, but fundamentally it is within the range of government target. The lower target set out for this year for the band of 4.5 to 5% actually allowed the local government more fiscal space to concentrate on supporting weaker segment of the economy. They don't have to be worried about spending money on fixed investment. From that point of view, yes, they do have a little bit more space. Don't have to worry too much about achieving higher growth target and achieving some sort of reform. But so far, it's too early to tell they are getting there yet.
It has the fiscal space, but the Chinese government, certainly policymakers, have larger goals in mind and concerns, for example, on addressing long-standing imbalances.
Absolutely. And you see this in the data, actually. Last year, the government talked about the anti-involution campaign. And here I'd say weaker investment number can be explained from two sides. One is healthy anti-involution campaign, but that's only part of the story. The other side of the story is also related to weaker private investment. And weaker private investment, if we look into the numbers, it goes beyond property, real estate. So from that point of view, I'd say the government still has a long way to go. And if you look at the strategic sector from aerospace to artificial intelligence, investment still grow. So from that point of view, I'd say the government remains to be very much industrial policy driven mentality. They are shifting investment capacity from segments that are no longer considered as a pillar. Instead, they remain to be very committed to continued investment in strategic sectors.
The temptation for both private and state investment to put their money in exports, given how much that is contributing now and has done to Chinese growth.
Yeah, Wei Su, you're absolutely right. If we look at the GDP number, using a mathematical formula, right, Y equals C plus I plus government consumption plus net export. Right now, the bright spot is net export. But I'd say this is not just a government mentality to support export. Private companies, they themselves want to sell overseas. And the reason is because significantly severe domestic competition and lower prices at home. So from that point of view, I'd say strong export is not just about government subsidy. It's really about private companies wanting to make money overseas.
Oh, thanks so much, Dr. Zoe Liu, looking into those figures for us and looking at the wider state of the Chinese economy. She's Maurice R, Greenberg Senior Fellow for China Studies at the Council on Foreign Relations, speak just there from New York.